Welcome back to the Bitcoin Noon Podcast, episode 42. How emotions impact Bitcoin. Today is a little bit different, guys and dolls. What we're going to do today is discuss how emotions really do impact Bitcoin. We're going to be weighing up the pros, the cons, the real problems that arise from our emotions, and some of the solutions that I've found over the years. So just to lay down the agenda and the foreshadow properly, this is not me trying to be a preacher or me trying to sound condescending or autocratic. By no means. I'm not a financial advisor. This is not financial advice. This is all stuff I've experienced and I continue to experience. And over the years, I've sort of managed to perfect these approaches, okay? It's a constant pursuit of perfection. And over the years, I've managed to hone it in and hone it in and hone it in. So what do I mean by hone it in? Well, this market is emotional. Over 80% of people trade based on emotions. Okay, that means only 20% have actually got a plan and a strategy. So some of these emotions that a lot of you might be feeling, listening to me today, might be optimism, might be fear, might be excitement, maybe a bit of uncertainty, maybe you might be confident, a lot of confidence. Maybe some of you out there might be panicking due to what you're seeing on the news. And some of you might be really greedy, really euphoric. So I'm just going to try and meet you at your level today. I'm going to try and discuss all these human emotions that we all experience. And it's important that we have a clear comprehension of these factors going into the markets or going into any endeavor in life, you know. I believe your mess is your message. Okay, so again, this is where I've gone wrong in the past, and hopefully you can learn from my errors so you do not repeat the same errors, okay? So let's discuss this then. So in terms of optimism, I'm going to go on some riffs here, by the way, so forgive me, none of this is scripted. As you know, all these podcasts are done in one edit. There's not a case of where I, record it, then edit these things. As soon as I record it, I publish it, and it's done. So forgive me, but this is how I like to be radically transparent and authentic. So I want to show you my flaws as well as my sort of good points. I find that real. Now, optimism, let's discuss optimism. So optimism could be implicated with price action, right? So an increase in price might lead to optimism. More buying as, you're anticipating future gains and future results and future money. So that can give you a lot of optimism. A lot of you might have fear. Okay, a lot of you might not have no skin in the game. You might own 0 Bitcoin, 0 cryptocurrencies, 0 assets maybe for some of you guys out there. So a lot of you might fear that the price is rallying without you. You might, hear the jargon, hear these podcasts and think, you're not doing what you should be doing. And you could have a lot of negative emotions around that. And I'm aware of that. So a lot of you who have got fear and you have got skin in the game, a lot of you might sell off too early to avoid potential losses. So fear plays a huge part of the market. Then you've got excitement. Okay, a lot of you would see Bitcoin made an all-time high this year last week on the 24th of October. And a lot of you may have a lot of excitement around that topic. There's a lot of speculative buy-in, a lot of hype, a lot of hysteria, a lot of rah-rah, la-la. And a lot of you, might think you've missed the train a little bit. You might have a little bit of FOMO, a bit of fear of missing out. The next thing I want to discuss is uncertainty. Okay, a lot of you might be listening to these renditions on this podcast and think to yourself, the market's too volatile. It goes up, it goes down, it goes up, it goes down. The price action underlying is just too volatile to get involved with. It's erratic, it's indecisive, and it's bipolar. And yeah, you'd be right in that. You'd be right. A lot of you, as I say, a lot of you might have confidence right now, okay? You've got a little bit of crypto on the side. You've seen your bags go up, okay? So you're holding crypto on spot and you've seen an increase in your underlying fiat true barter and you think you're the new Wolf of Wall Street. So a lot of you have a lot of confidence right now. You've struck lucky, okay? You've hit the jackpot. And you want to be very cognizant of these emotions because they will jeopardize your executions if you're not taming these emotions. If you're not aware and identifying these emotions in real time, they will govern what you do. This is why what we do over here is look at formula over feelings. This is why we've got a systematic approach, so our feelings do not self-sabotage our progression. So this is what I'm going to be going into, right? Now, a lot of you might be suffering from, what's the word? Panic, okay? You might see chart go up aggressively, then you might see it go down aggressively, and thus you might be in a state of panic. Or you could be watching the news, simply put, and you're seeing all this war, all this injustice, all these political things I'm not going to go into. And, you know, you might be panicking, and rightly so. We're in an interesting time of human evolution in our timeline of humanity. There is a lot of onshore headwind and a lot of offshore headwind. So yeah, a lot of you might be in a state of panic right now. You know, the cost of living crisis, paying your bills. That's a lot of panic for a lot of you guys. And if you don't know how to identify that and how to, you know, contain that and control that, that panic will move your hand. It will force the needle. And then last but not least, greed. Okay, you see these rapid price movements, and then some of you might want to get over leveraged. And you know, you want to make quick bucks and lead to quick gains. However, that can lead to quick losses, you know. I've got a saying which goes something like this: sheep and pigs get slaughtered, right? Sheep and pigs get slaughtered. So what does that mean in layman's terms? It means that, dude, if you're greedy, you're going to get slaughtered. If you copy Tom, Dick and Harry like a sheep, you're going to get slaughtered. So these are the things I need to sort of instill first and foremost, right? This is episode 42, how to manage your emotions and how emotions impact Bitcoin specifically. So optimism, fear, excitement, uncertainty, confidence, panic, greed, they all go hand in hand. It's a rainbow of emotions, and as humans we all go through it, myself included. So let's identify the real critical problem of these emotions, and let's identify the critical solution to the problem. So I want to draw your attention to overreacting to volatility, right? Overreacting to volatility is the key problem I see quite a lot with my students and my subscribers. The only way you can combat that is by having a set long-term goal, meaning, you know, instead of reflecting on short-term fluctuations, maybe focus on the long-term investment thesis, you know, the underlying analysis of the fundamental value of Bitcoin, let's say. That's the only way you're going to be able to control overreacting to the volatility. As you know, volatility is not direction implied. What is direction implied is the trend, volume, and momentum. Volatility is simply a catalyst. It's simply an explosion. It's simply oomph. It's like, you know, it's energy. That's all it is. You can't be scared of energy. Energy never dies, it only transforms and transfers. The next problem I see is FOMO. We've touched on this in the foreshadow, but I see a lot of people, you know, just aping in. That's what we call it in the industry. We call it aping in, you know, going all in on a trading thesis. We don't do that. You know, we don't chase waterfalls. We don't chase water pumps. We don't do that. Nor should you. Now, what's the solution, right? What's the solution? Because it's only human to have FOMO, right? The solution is this. You have to research before investing. That's simply it. It's a three-word solution. Research before investing. That will mitigate the problems of fear of missing out. So how does that actually look? You take the time to research and understand the market trends instead of impulsively buying during a massive surge in market liquidity. You take the time to go on the internet, go on YouTube, go on ChatGPT or Google Bard, whatever AI service you like, and simply ask the questions. That's it. Now, the next thing I see quite a lot is panic selling. Okay, we've seen a big move, or we see a big move, whether it's to the upside or downside, the polarity implies itself, and then people just randomly sell. They just panic sell. Okay, this often tends to be when people are underwater holding a loss, and then as soon as they get above water, catch their breath, they want out the water. They're not built for this water life. They want out straight off. They want to dry themselves with a towel and get the F out the water. And rightly so. If you've been underwater holding your breath and you come up, you gasp for air and you get some air in your lungs, and yeah, you're going to want to get out that water ASAP. I understand that. I do. But as technicians, as statisticians, as people that are Bayesian technical analysis nerds, that way inclined, what we do, something slightly different. Instead of panic selling, we establish a stop loss. Okay, we establish a stop loss. So what does that mean? We use automated tools to prevent selling at a loss during a panic. So we predetermine these levels so we're not emotionally charged in the moment. This is the only way we sort of dance around that problem. We have a cut-off point. Now, for some of you, you might want to go a little bit deeper than just having a binary stop loss. For some of you, what you might want to do is focus on your risk per trade. So let's say you've got 100,000, you're only risking 1 to 3% of your total portfolio. That will help you manage your emotions better, which implies you're only risking 1 to 3,000 of your total 100 grand. Or let's dumb down the maths. Let's say you've got £1,000. You're only going to be risking what? £10, maybe £30 at the very, 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 very most. Again, not a financial advisor, not financial advice, just something that I've experienced before, and it's something that I've ingrained into my strategy now. I'm not going to be risking 100% of my portfolio, nor 50%, nor 25%, let alone 10%. Typically between 1 and 3%. And then we'd have a stop loss even still built into the trade. So we're risking a small sliver of the portfolio, and then we're putting a stop loss to mitigate, further degradation on the portfolio. So it's just risk management. I think risk management is the real stickler here when it comes to panic selling, as it were. Next thing I want to discuss is overconfidence. I see a lot of overconfidence in times like now when Bitcoin's made a massive move, one of the biggest moves it's made in 2 years, and I'm seeing a lot of overconfidence, and you want to G-check that. You really want to G-check that. We see steady price action, so some of you guys think, oh, we're back in a bull market. It's 2017 again, or it's March 2020, we can just buy anything and get rich for a year solid. I don't think it's like that right now. I want to G-check that. I'm not going to blow smoke up your ass. I don't think it's like that right now. We look at the geopolitical backdrop. We look at market sentiment. I don't think it's like that. But the idea is simple. The idea is simple. How to overcome overconfidence is you diversify your portfolio by balancing your crypto investments with other assets to mitigate risks associated with overconfidence in one market class. What do I mean by that? I mean, maybe get divisibility or exposure into the precious metals, i.e. gold, silver, platinum, palladium. Pick any one you want. The next thing would be, I want to stick on this. Gold made an all-time high this year in May, by the way. I think that's worth mentioning. Gold made an all-time high ever this year in May. So maybe you want to diversify your portfolio, hedge your risk, hedge your bets. Don't have all your eggs in one basket. Maybe. Or maybe you just want to go long cash, just work hard at your day job, maybe get another side hustle and just store cash. That's another form of diversification. Nowadays, we've got things on our mobile phone like Vinted, eBay, Spock. You can list any item, clothing-wise, you don't wear, and you can make money, That's a form of diversification outside of your employment, your main employment. That's what will sort of G-check the overconfidence. Now, another thing I want to mention is emotional trading. We've sort of danced around this a little bit, but I really want to go into it in the nth degree here. Emotional trading is what you want to avoid. You want to avoid emotional trading like the plague, okay? How do you do that in simple terms? You have an automated trading strategy in place. What does that look like? You use trading bots, indicators, algorithms, much like the trend volume indicators. By the way, 7 days completely free, and it comes with 1 hour coaching session with myself, completely free for 7 days. You can have full access to our software, and it will tell you what to do based on statistics and probabilities. Not crystal ball, Mystic Meg, get it out, roll the dice, blow on it, see where it goes. That's not our sport. Not our sport. What gets measured gets accomplished. 1 + 1 = 2. No matter if you're pink or blue. No matter how you feel today. It's observations over opinions. So the only way you're going to G-check your emotional trading is by having an automated trading strategy. It strips out the emotion and makes it binary. It's the only way. It reduces the emotional impact on trading decisions, so you can make data-driven decisions, which is what you should be doing. Playing the probabilities, playing the statistics, and that edge will play out over time. It's like being the casino house, right? The casino house always wins over a period of time. You might have the odd punter that walks in and makes a fortune, and the casino loses a lot of money, but over a period of time, the casino will always win because they know their edge. They know their statistics, they know their probabilities, and they play it. That's their game, that's their sport. We're not the punters, okay? We'll leave the punting behaviour to Tom, Dick and Harry. We're not Tom, we're not Dick, we're not Harry. The next thing I want to mention is lack of discipline. A lot of you know what to do, right? A lot of you've got the indicators, you know when to buy, you know when to sell, you know what the trend is doing, you know what the volume is doing, you know what the momentum is and the volatility, but you're still effing up. For some reason, you're still effing up, and that's fine. You know, I've been there myself. And it's a lack of discipline. And the only solution for a lack of discipline is having a concrete, ironclad trading plan, which basically means you've backtested your strategy on multiple indices, on multiple different markets, on multiple different time fractals, and you know your hit rate expectancy, you know your risk to reward ratio, you know how much times you're right, you know your batting average. In sports they call it a batting average. Let's say you've got a 60% hit rate, meaning if you take 10 trades, you're going to be wrong every 4 trades, right? Or you're wrong 4 trades out of 10, let's say, right? 60% hit rate. What does that mean? It means when you're losing those 4 trades, are you blowing yourself out? Are you jeopardizing your portfolio? Are you jeopardizing your fiscal firepower? If so, you're betting too much. We've covered this already. You want to be dropping it to 1 to 3% of your total portfolio on risk, if you are to risk anything at all. But firstly, you have to have a trading plan, you have to have a trading strategy before you deploy any sliver of your portfolio. There should be no percentage of your portfolio invested or traded until you've got a trading plan that's ironclad and you've tested it for months and weeks and months and years and years. There's no shortcut to success. This is not a magic pill where you sign up to my trend volume indicators and you get rich forever. You've got to have discipline. When I was growing up, my father, forced me to go to Sunday school till I was 18 years old. That's discipline. I was not allowed to go out to play with the local kids until I learnt my times tables. That's discipline. I went to Taekwondo twice a week when I was a little boy. And I was a black belt at age 9 years old. I'm a black belt in Taekwondo at age 9. I'm now 30. That's discipline. And it goes through every endeavor in life, not just trading, right? You see there's a lot of overlap here. It's character. It's your character. If you get knocked down 8 times, are you getting up the 9th, or are you staying on the floor? That's character. That's discipline. So cool. Now, the last thing I'm going to leave on, guys, is this. Information overload, right? Information overload. A lot of you are sensory creatures. You've got a lot of emotion and you get sensory overload. Especially now. We turn on the favourite news channel in the UK called BBC, and we see a lot of information overload. We see a lot of propaganda, a lot of hysteria, a lot of, injustice. It's clear injustice what it is, what we're seeing on our TV screens. So how do you work around that problem? You curate reliable sources. So you only follow a few reputable news sources and you do your own research. I'm a huge bastion to journalism, but citizen journalism, right? Citizen journalism. So I'm on X, which is formerly Twitter, which is Elon Musk's app. And on there, I believe it's the second news app on the App Store, I believe, on iOS. But on there, you're going to get a lot of alpha, a lot of information from people that are out in the field, not people that are being paid to wear a suit and tie and read off a screen. That's nonsense to me. Be careful where you get your advice from. Be careful where you get your counsel from. Often they should be different places. So I think we've kind of gone through this, how I want to go through this first rendition. There will be many episodes like this where we sort of strip down the psychological analysis, because I think that's super important and often overlooked. It's not about having money or making money or having Bitcoin or not having Bitcoin. That is nonsense, especially in a bear market, and we're in a bear market. You have to get your brain sharp. If your brain is sharp, you will get money. Well health equals wealth. The Greeks coined that terminology, right? Well health is wealth, right? And it starts with your head, your mental health. So we have to discuss optimism, fear, excitement, uncertainty, confidence, panic, greed, overreacting to volatility, FOMO, panic selling, overconfidence, emotional trading, lack of discipline, information overload, right? The solutions are long-term goals, research before investing, establish stop loss and risk management parameters, diversify your portfolio and income, automate a trading strategy so your feelings do not self-sabotage you, create a trading plan and stick to it, and curate reliable sources of where you get your data from. Clean data, not dirty data, not propaganda data, clean data. So yeah, cool. That's really good. That's 22 minutes of alpha. Now let's jump into the technical analysis and let's look at the charts. So now we're going to be looking at the monthly, the weekly, the daily and the 4-hour. And then we're going to wrap off and leave it there. So let's quickly blitz through this. So nothing's really changed, okay? We see a new monthly open today. So we've got a monthly expiry yesterday. We've now got a new open today. What does that mean? It just means there's 29 days and 13 hours left of November. 29 days and 13 hours left of November. We've got 79% sell pressure engulfing the market on monthly open. So again, the bears do have the upper hand. The sellers are in control, something we can measure and, keep our fingers on the pulse with, using our Trend Volume Pro version 3 indicator. Again, very simple. As long as we're underneath 37,000 on a monthly time fractal, I'm not interested in speculating to the upside. I think the path of least resistance is back towards the downside. Okay, very simple there. Now let's pull up the weekly and let's see what we see. So looking at the weekly, what do we see here? We do see selling pressure engulf the market. We do see 59% sell pressure this time, with 4 days and 13 hours until the weekly expires. What we also see here is volatility expanding, which is the white line you see on our trend volume inflection indicator. And we do see the stochastic momentum creeping up as well. However, we do see the RSI starting to dissipate. Now, that dissipation is a real thing and it will continue waning to the downside as long as Bitcoin is underneath $34,538. That number again, the relative strength index will continue falling underneath $34,538 as long as Bitcoin's failing to reclaim that region. Right now it's underneath it by approximately $138. Risk is to the downside and velocity will continue as such until that area is reclaimed, if it is reclaimed. Okay, cool. Now let's go into the daily, and then we're going to go into the 4 hour, then we're going to wrap it off. So looking at the daily, what do we see here? Well, this is a signature that we've been basically analysing and attentively keeping our fingers on the pulse with. I think that's the saying of the day, keeping my fingers on the pulse. But that's to say this, we've been working out that the momentum's been in the critical zone for many, many weeks now. We can see that momentum is slowly creeping back towards the downside. That is confirmed by two factors, both the RSI and the MACD, which is the moving average convergence divergence. Now, both of those inflections will continue to wane to the downside under this criteria. The RSI will continue falling underneath $34,660. The MACD will continue falling underneath $34,837. And the volatility is aggressively contracting from being nearly at 100 percentile. It was at 97 percentile. Remember, this is measured out of 100 volatility is. And basically, it's been contracting ever since. So I'm keeping it simple. Both the RSI, MACD, and stochastics, we're all measuring that out of 100 on this inflection metric. So cool. All you need to know is that they're falling down, and what's in motion stays in motion until it stops. And it's not stopping yet because you think it should. So another thing I want to mention is this. So last week, Bitcoin did make an all-time high this year, successfully taking out the July high from prior. So July was the yearly high until last week, Tuesday, on the 24th of October. Now, that's not coincidence. That is not coincidence. We've got 77% sell pressure engulfing the daily with 12 hours and 20 minutes until expiry. What I want to do is bring your attention to the dollar. So if we look at the dollar, what we can see here is an inverse correlation. A lot of you know I'm a huge advocate of this inverse correlation between the dollar and Bitcoin. To study Bitcoin, we have to study the DXY, which is the US dollar index. And that basically means this. The dollar's been rising ever since July. Okay, July the 14th if you're being cute. All the way up until October the 3rd. Okay, then October the 3rd, the dollar had a cool off period. A consolidation we call it. Which is perfectly natural from something that's gone parabolic. It's only natural to have a few weeks off, It's like having half term if you're a kid. You go to school, you have half term or summer holidays. The dollar has just had its summer holiday or autumn holiday, as it were. Now, the idea is simple. Since the 24th, the dollar's been going back up. So the dollar fell on the 3rd from July all the way to the 3rd of October, cooled off, then started back up on the 24th. So it took a 3-week hiatus, a 3-week trip to the mountains to see the monks, to meditate. Now it's coming back to fuck shit up. Now that thesis remains ironclad as long as the dollar is above its Tuesday low, which was Bitcoin's yearly high. Bitcoin's yearly high is the dollar's low. Inverse correlation textbook 101. Welcome. So again, if we go into Bitcoin, I want to show you what happened on the 3rd, okay? What happened on the 3rd of October? This green line here was the 3rd of October, guys and dolls. This basically marked out the bottom of this saga, and then we rallied. As soon as the dollar cooled off, Bitcoin rallied the last 3 weeks. Now the dollar is back in town, Bitcoin is retreating and hibernating. And it's been that way since last Tuesday. Success leaves clues, and we measure it every day on the Bitcoin Noon podcast, Monday to Monday. No days off, no weekends, no bank holidays. Money does not sleep. Okay, cool. Now let's go into the 4 hour and let's bring this bird to a landing. So looking at the 4 hour, what do we see here? Well, first and foremost, I want you to bring your attention to these white lines you see on your chart. What we've done here is go into the Trend Volume Pro version 3 indicator and simply turn on these lines. These lines depict support and resistance, basically supply and demand. And at the end of the day, we look at rebalancing our portfolios when price action, reacts to one of these lines, keeping it very simple, right? Now, in this circumstance, this white line here that you see is the resistance and price action underneath it. No shock there. We've got 61% sell pressure. We've got a negative slant as well on this historical average, which is very bad, by the way. If it was bullish, it would be incline postured as opposed to decline postured. Right now it's decline postured, which is very negative. Despite it being green, it will flick back to red as soon as price action goes underneath. So I just want to quickly zoom in on that so you can kind of see what we're talking. It's whiskers away from being confirmed. And with the sell pressure we've got at the moment on all time fractals from a monthly, weekly, daily and a 4-hour basis, volume is telling me it's likely to go down, and so is the momentum. Now let's extrapolate that for what it's worth. If we're looking at the trend volume inflection indicator, we can see there is confluence across all of the oscillators towards the downside, meaning RSI, MACD and stochastics are all falling in tandem and will remain so under this criteria. The RSI will continue falling as long as Bitcoin is failing, which it is, to govern back above 34.4. The MACD will continue falling as long as Bitcoin's failing to reclaim back above 34.5. And also the stochastic momentum will continue waning velocity to the downside as long as Bitcoin is failing, which it is, to close back above $34,379. So I just want to reference that properly, okay? So yeah, we're not out of the woods. Volatility is contracting as well, which is a recipe for, well, further continuation. I think this move does have legs. Now, what you should be watching for today is this, guys and dolls. If we turn our attention to the real world, back into the real world, today we've got Jerome Powell speaking from the Federal Open Market Committee, better known as the FOMC, approximately 6 p.m. GMT, I believe. So what does that mean in layman's terms? It means the people that control the M2 money supply in America are discussing monetary policy later today, and I expect it to intensify the hawkish sentiment we see spearheaded around the West. Cost of living crisis, costs more to purchase the same goods and products, that type of stuff, right? Now, tomorrow we see the Bank of England, Mr. Andrew Bailey, the mouthpiece, discussing the UK monetary policy, which will fit hand in glove with what America say later today. The BOE acquiesce, bend the knee and kiss the ring to whatever the Federal Reserve say, which is coming out later today. So what that means is this. I expect volatility between today and tomorrow. I would urge all of you not to get wrecked. Don't be a victim of this, because the market will trick or treat you, pardon the pun, the market will trick or treat you between today and tomorrow. And it's an intense volatility saga. I would rather go risk off if I was dropping my 2 cents into it, right? If we know a storm's coming, we don't go out into the storm thinking we know what's going on. We'd rather hanker down, stay indoors. When the storm's over, we'll resurface when the dust has settled, which will likely be on Friday. Okay, that will likely be on Friday. Then we'll see how we want to posture from there. So I'm going to leave it there. I think that serves you guys well today. Hopefully you've learnt something. Each one teach one. I'm a firm bastion to that. I do not know everything. I'm simply sharing my experiences and what I've learnt over the years. And hopefully that inspires some of you out there. So I'm going to leave it there. God bless. Until the next one. That's episode 42. I'll see you tomorrow for episode 43.